What's up guys, it's Nathan here. In this eye-opening video, we're going to dive into the recent address from Philip Lowe, RBA Governor, where he unveils the distressing impact of rising interest rates on Australian homeowners. Discover the tough choices faced by the Reserve Bank and how it affects mortgage repayments. We'll also explore the latest update and unexpected twists in the housing market. From skyrocketing prices to regional recoveries, you won't want to miss this insightful analysis. The Reserve Bank Governor Philip Lowe has conveyed a significant message to countless Australians wrestling with escalating mortgage repayments. In an address at the Morgan Stanley Australian Conference, Lowe admitted that the bank's actions are distressing to those that have mortgages, especially recent buyers with hefty mortgages. However, he emphasised that there was no alternative for managing supply and demand to mitigate inflation. Interest rates serve as the Reserve Bank of Australia's mechanism to maintain this balance, Lowe stated. I realise that implemented this mechanism has its complexities. The effects are unfortunately distributed among the community unevenly, with increased interest rates exerting substantial financial strain on certain households. But this inequality doesn't justify us not to utilise the tools available. The Reserve Bank of Australia exercised this tool recently, further raising the interest rate to combat inflation, setting the official cash rate at 4.1%. Lowe argued that the extreme short-term discomfort some families are currently facing would escalate if the bank failed to elevate interest rates to curb inflation significantly. There's no doubt that by not hiking interest rates, a number of Australian households would be momentarily sidestepping the financial pressures that come with increased interest rates, he explained. However, this fleeting relief would have to come at much steeper costs in the medium term. He also added that without strict monetary policy, the cost of living would have remained elevated for an extended period of time, causing detrimental effects for all Australians and our economy. He also warned that it would eventually necessitate even higher interest rates to bring down inflation back under control. When asked about the threshold at which he expects a significant rise in mortgage arrears, forced sales and defaults, Lowe indicated that the majority of borrowers were coping according to the Reserve Bank's discussions with the banks. However, he conceded that achieving his goal of reducing inflation without causing a recession or drastic unemployment rises will be a challenging task. And if you find value in this video, please consider hitting that subscribe button, as it really does help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. While Lowe further highlighted that while interest rates were effectively curbing demand and price pressures in the economy, it's premature to claim victory over inflation given the anticipated surge in services costs, rents, and electricity prices this year. High interest rates, wage increases, and lackluster productivity growth all present challenges in bringing inflation down to the target range of 2 to 3%, according to Philip Lowe. He emphasized that the importance of boosting productivity growth to mitigate inflationary pressures caused by wage increases. Lowe discussed unit labor costs, which quantify the wage cost for employers to produce a specific level of output. These costs had roughly increased by 7.5% in the past year, making it one of the most significant annual increases in decades, although they fell during the pandemic and were generally weak post the global financial crisis. Continued strong growth in unit labor costs could support ongoing high inflation outcomes, warned Lowe. He suggests that stronger productivity growth as the best solution to moderate unit labor cost growth, which would also support durable increases in real wages, national wealth, and resources to fund public services. However, Lowe regretted that weak productivity growth over the recent year, with output per hour worked today at the same as it was at the end of 2019, suggesting that there was no net productivity growth since then. The governor did not comment directly on the 5.75% increase in the minimum wage announced by Fair Work Commission last week. However, he did note that it was among many factors influencing inflation. There are numerous factors, and when they all point in the same direction, it implies a shift in risk, Lowe said. He also noted that the board is closely monitoring both wages and productivity measures to assess what kinds of pay rises are compatible with bringing inflation down to the target level. He expressed that the current wage rises don't seem excessive, but it depends on the resurgence of productivity. The Home Value Index, an assessment tool developed by CoreLogic, noted a third consecutive rise in property values, registering a 1.2% growth in May of this year. This surge followed a 0.6 and a 0.5 increase in property values in March and April as well. Sydney emerged as a frontrunner in this rejuvenation, boasting a 1.8% increase in values in May. It's the highest monthly leap we've seen since September of 2021. Brisbane and Perth followed closely behind, both posting growths above 1% at 1.4 and 1.3% respectively. The revival in Sydney's housing market saw the high-end segment outperform others. The upper quartile enjoyed a significant 5.6% growth over the last quarter, dwarfed by the 2.6% rise in the more affordable quartile. Tim Lawless, the research director at CoreLogic, stated that prospective buyers were targeting the premium market while prices were still below their peak levels. Despite the fast appreciation in prices of expensive homes, the values in the upper quartile in Sydney's most expensive markets remained 11.8% below their peak observed in January of 2022. This discrepancy resulted in a saving of around $213,000 off the cycle high. Lawless highlighted an increase in competition among buyers spurred by limited housing inventory available. This escalating competition was reflective in the consistently high auction clearance rates, which held steady at over 70% in the past 3 weeks. Private treaty sales saw homes selling more quickly with fewer vendor discountings, hinting at a shift towards a seller's market. Outside of capital cities, regional areas have also begun to show signs of recovery. The combined regional index rose by 0.5% in May, preceded by a 0.2 and a 0.1% upswing in March and April, respectively. However, the growth rate of regional homes are lagging behind the capitals. Over the past quarter, the combined capital cities index growth rate was over 3 times of that of the combined regional index, 2.8 versus 0.8%. Despite a tight housing supply in regional Australia, net overseas migration demand was comparatively low. ABS data showed about 15% of the country's net overseas migrants each year is located in regional areas. A decline in internal migration rates across these regions also helped ease the demand side of the housing market. However, the recovery of housing markets varied across major cities. Despite growth, most markets still report values well below their recent highs. Perth, for instance, was the only city where home values had recovered to record highs. In contrast, Hobart home values were down 12.6% relative to the city's peak in May of the previous year. Sydney, Brisbane and Melbourne home values are still 9.6, 9.4 and 8.2 below their respective peaks in January of 2022, June of 2022 and February of the previous year. The real estate scenario in May highlighted a declining number of homes listed for sale, falling 13.1% and 18% below a 5-year average in combined capital cities and regional areas. Despite a marginal upswing in estimated home sales, they remain below the highs of late 2021. Lawless attributed this pressure on housing values to the gap between the demand and available housing supply. National listings averaged 35,000 over the past quarter, while an average 39,000 dwellings was sold in the same period. The last time capital cities inventory was this low was in 2007, a period marked by high overseas migration influx and increased home values. The National Rental Index recorded a 0.8% increase in May, which surpassed the pre-COVID monthly average rise of 0.2. However, this is a slowdown compared to the recent monthly growth rates of 1% in March and 0.9% in April. The deceleration in rental growth was most evident in regional markets where rents rose only by 0.3% over the last month, while capital cities' rents rose and increased by 1%. Additionally, the growth rate in capital city houses was only 0.9% compared to that of units, which was 1.4%. Amongst larger capital cities' unit markets, rent experienced the sharpest rise. Over the last quarter, Sydney rent prices grew by 5.7%, Perth and Melbourne unit prices increased by 5.2%, and Brisbane by 3.8%. With growing demand for rentals, the market awaits more signs of a supply response. Rental listings in capital cities were significantly down at the end of May, 36% lower than the previous 5-year average, and vacancy rates are still at an all-time low, below 1% for both houses and units. There was a glimmer of increased investor activity in the market as well. The volume of new investment housing loans bounced back from a recent low of 11,500 in January to around 15,300 in March. However, investment loan volumes were still 29.4% down on a year-on-year basis. Uncertainty persists over the sustainability of the housing market recovery due to several factors. One is potential for further rate hikes, which may cause higher levels of mortgage stress and perpetuate low consumer sentiment. Another is rapidly growing house prices could stimulate the wealth effect, presenting a risk on inflation as households perceive an increase in their wealth. And the last is refinancing of fixed-rate home loans reaching their term could potentially escalate mortgage stress. While higher interest rates may dampen demand pressures by reducing borrowing capacity and sentiment, demand from a record levels of high overseas migration is anticipated to continue. And remember to like, share and subscribe to stay informed with all things property and finance. With improved selling conditions, more homeowners might put their properties on the market. Historically, the flow of new listings is low during the winter months. However, if more vendors try and take advantage of improved market conditions and sell before the spring rush, available supply could rise, bringing a balance to negotiation power between both sellers and buyers. Did you know here at Hunter Galloway, we're mortgage brokers and we get loans approved and we deal with people Australia-wide. So if you're looking to get in the market for your first home or even investment property upgrading or downgrading, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au. We'd love to help. Guys, as always, thanks for watching and we'll see you next time.